Okay, great. So let's start this session. I'm going to disable the chat for you so that I can enable it at the end when we take question and answer. If we take question and answer, because it's not a Q&A type of meeting. The objective of this meeting is to put my views in front of you. You like it, great. You don't like it, ignore. There is nothing to, discuss. As I already mentioned before, this is the newsletter that we had already shared on 29th of March. Has market made bottom? And I put forth some of the points in front of our client that whether the market has made bottom. If yes, why, first of all? And if yes, what we are going to do about it? If no, then why not? So that was the whole objective, and but that is what we are going to discuss here, right? So instead of making all those presentation, what I've done is I have put the newsletter itself in front of you. This is a word format of that thing only. So there are 7 reasons why I believe that the market has made bottom. 7 is a lot of reasons, by the way. Uh, then sometimes we get 1 or 2 reasons only to realize that the market has made bottom or market has made top. Historically, we have seen that out of 1 or 2 reasons, we have to take a call. But this time there are 7 reasons why we think that market has made bottom. And more, all the reasons are very significant reasons, not like there are some not reasons which are insignificant or can be, uh, you know, avoided or can be ignored, right? Before I start this, let me just tell you that we collect data and we analyze it. We are not some future prediction people, or we don't see planetary movements, or we don't do fortune telling. But I'm going to share my views with you, and I'm going to give you the justification behind it or the logic behind it, right? As I said in the starting itself, please make it a take it or leave it deal. If you don't like it, ignore. That's it, right? So the first point is our in-house generated valuation index. You already know, if you are associated with us, that we have in-house generated valuation index, which tells us whether the broad market is undervalued or overvalued, right? For the people who have been listening to this for the first time, let me just tell you that this is in-house valuation model, where more the divergence, more the overvaluation is there in the broader market, right? It's not based on index. Index one is this one, right? We are going to discuss this also, but let's discuss this one right now. So if the blue tick is above and the divergence is huge, it means the broader market is very, very much overvalued. So you can take the example of 2008, then 2011, and then 2015 or so, then 2017, then 2021, 2025, and 2024, and 2025, right? It's very much clear. About the undervaluation also, it has been very much clear historically. 2009, 2012, 2014, and then 2020, it has given clear signals wherever markets have become undervalued. And very great parameter, because valuations are always in the present. They are not lagging indicator. They are not, you can lag by 1 month or 2 months. You are not going to lag by 6 months. So they historically tell you way better things about the market than any other indicator. So what we can see right now here in 2026 March, market is in fair valued zone. So this is a broad market index. We can see market has been fair valued. Also, this has been the time where we have made bottoms multiple times. So let's say in 2006, 2007, we made bottom here. 2021, we made bottom here. 2022, 2023, then 2025, we made bottom here. And now we are here in 2026. This is not kind of undervaluation which we saw in 2020 or 2013 or 2009, but we have seen fair valuation. So that is point number one. We are not going to conclude based on this. Why? Because it is fair valued zone. It's not undervalued, right? But if you look at index undervaluation, overvaluation, this is what you see, right? You can see it from 2001 to 2026. It is done on Nifty, right? And you can see the divergence is very, very little, and the market is very, very near to undervaluation. So index is undervalued, broad market is fair valued. can we say that the short-term bottom, short-term or mid-term bottom is near? I think reasonably we can say so. Or the better explanation would be that there are some sectors where the bottom has been formed. There are sectors where the bottom may not be formed, but so we have to be cautiously invest where the bottom is there, where the valuation is there. Okay, so this has been one point here. Second point. Second point is time of correction. In last 20 years or so, the world markets have seen the shrinkage of time of correction. In 1960s or 1940s or let's say 1929, the bear markets used to be wide, and when it comes to the time horizon, they used to they used to last for 4 years, 5 years, 7 years. But as we are progressing in life, for last 30, 40 years, bear markets are being shortened. And the biggest bear market we have seen in the last 20 or 30 years or so are 1.5 years, 18 months, 20 months, at large 22 months we have seen. Some of the examples that you can see here, March 2000 to September 2021. Also, some of these time of correction you cannot see in the index because index tells a whole different story. So March 2022, I'm talking about broad market here. So March 2000 to September 2021, January 2008 to March 2009, November 2017 to July 2019. These are 18 months corrective cycles. In the newsletter, I wrote March here, which was wrong actually. It was July 2019. So 18 months, 18 months, 18 months. Most, the biggest correction we have seen has seen a correction of 20-22 months. And if we calculate from September 2024 to March 2026 also, that is also more or less 1.5 years. Now, is it some kind of pattern recognition, or just because 1.5 years it has been for last 20 years, it is necessary that it will be 1.5 years? No, it's more of a psychological thing, right? For 1.5 years, there has been no money making in the market. So that tells a different story, right? And that tells that the cycle will turn. Third thing, this is a short-term bottom indicator. We sometimes use it. Sometimes it works, sometimes it doesn't. So we don't share it enough. That what we take is for weekly market, how market has performed. You can say 4 weekly candle if you want to talk in technical terms, but this is not a technical indicator. If market has gone down, and this is talking about Nifty, if the Nifty has gone down 4 weeks straight, this is a huge psychological indicator that market can make a bottom here. As I said, this indicator works great when the market is fair valued or undervalued. It does not work when the market is overvalued. As you can see, here also we saw 4 week of correction, but market did not make a bottom here, right? As you can see here, it made a fair bottom, right? And this is a short term too. So for with a fair accuracy, you can say for at least short term, we have seen the bottom, right? Fourth point is the gold overvaluation. So this is a gold valuation chart. We had shared this, and what we have seen is whenever gold becomes overvalued, right? If I tell you how, which parameters we do use to make these gold valuation charts and all those things, it will take 1 hour, half an hour just to explain this only. So I'm just explaining the results of this, right? So the gold valuation chart suggests that the gold has been overvalued, and gold became overvalued in January nearly. And whenever that happens, as I have written also, generally the big money moves back to the equities, right? And that gives a huge surge to equity markets that we have seen in the historically, right? And since market is undervalued and market is fairly valued, gold has become overvalued. It means it seems fair that the market, that the money will shift to equity. Now, a question comes that, hey, Nikhil, just 1.5 years back, when the market was hugely overvalued, as you can see here, and gold was undervalued, then why didn't we go into gold, right? That was the most rational choice. We should have gone into gold. So instead of what we see the correction of our portfolio of 14-17%, nearly 14 to 17%, it would be up by 30, 35, 40%, right? So why did not we go into gold? Now, here's my explanation. From the start, I started my journey in 2013. From the start, I have been an equity investor, right? Never invested in gold, FD, mutual funds, PPF, EPF, whatever NPS, whatever name you want to give it. I have never invested in those companies. I have never invested in those assets, right? And what I know is the more market goes down, the revenge recovery it makes also. And you never know when the recovery is going to be. So I prefer staying invested. I've seen 13, I've seen 17, 18, I've seen 20, and I have seen this 50, 25, 26 also. Most probably, I am very much satisfied with the performance that I have generated. And mostly I am satisfied with the performance that we have generated as an advisor also. But as an advisor, this was the first time we saw the correction, right? So we started in 2022. We saw 6-8 months of correction, and then market did well. And 25, 26, 2 years of market as an advisor, this is the first time we saw correction. And this have made me realize a lot of things. Along this, this is one thing that I have realized is that a lot of investors, they say that they are long-term investors, 5 year, 10 year, 20 years of holding period, they commit. But at the end, what boosts the confidence or what matters at the end is 6 months or 1 year rolling returns, right? This is the hard truth that we have realized as an advisor, right? So we have realized this, and we will make sure in the next time when the market becomes overvalued, we will make sure to churn 10, 20, 30, at least 30% of our equity into gold. And when we do, we are going to be, I mean, we are going to be at least 20, 30%. We will go big. We will not go 5%, 7%. Right? So this is one realization. I mean, now I'm not here to judge anybody that you said you will be investing for 5 years, 10 years. Now you are saying that uh, we did not perform for last 1 year and you are being all this aggressive and all. Although I should say that, right? But what this is all about realization, what we have done, right? So we have realized this, and we will take care of this. So this is what I have written, right? So every time the market becomes overvalued, we will allocate 20, 30% just for the satisfaction per se of clients, not because we want to create a lot of money, because this time gold has given huge returns. A lot of times it just protects the capital. That's it. It'll give you, let's say, 7 to 8% while the market goes down by 30%. So mostly it just protects the capital. This time the gold has given this kind of returns, so we are facing more and more doubts related to this. Why didn't we go into gold and all that, right? So that also we have to realize on one point of time. Now the fifth point is behavioral. No, the fifth point is very important actually. The market panic is extremely high. As if you can look at SIP stoppage ratio, I will talk about SIP stoppage ratio also. Now everyone knows that crowd is wrong. People say that crowd is wrong most of the time. I don't believe in this. I think crowd is right most of the times, 80% of the times. There are only wrong 20% of the times, that is top and bottom. So they liquidate when they have to go all in, and they put all in, they go all in when they have to liquidate. So this is the 10% and 10% when they are wrong. Most of the times they are right. And that is the kind of thing we can see in the SIP stoppage ratio, because it's a cumulative action of the crowd. It's a cumulative action of all the SIP holders, all the investors and all that, right? We can see panic by investors' confidence. People are talking about World War III. People are talking about uh, oil going to $200 and all those things. Brokerage reports, we will talk about brokerage reports. We will talk about social media sentiments. You already know people are giving targets at 19,000 or something, right? Now, the whole narrative has been said that market has been correcting because of the war, right? Now, if you look at the history of last 10 wars, market has never corrected. In fact, market has given positive returns, right? If the market is correcting because of the war, then Tel Aviv market should go down, Israel market, Saudi market should go down. This is how Tel Aviv market looks like. This is how Saudi market looks like. The last 6 months, they're going, they're making all-time high. Saudi, it went down, but recovering fast. Only the Indian market is going down, right? So it is definitely not because of war. It's just the narrative. It is not because of the war. It is because of the overvaluation that we saw here, right? When the market is overvalued, I will also share when did we talk about the market overvaluation in last 2025, July, that I will share. So first, please remove this assumption from your mind. Okay. So please remove this assumption from your mind that the market is going down because of the war. Okay, it's not. It is going down because of its own weight, because of overvaluation. And now, since it is undervalued, it will go on its own course, right? Now, of course, I'm not including if, let's say, because of this, because of all these blasts, energy outputs decreases and energy prices increases, that will have an impact in the long run, let's say 5 years, 10 years, right? But current market is going to run on the steady course as it always has run. Okay. Sixth, contra indicators. There are many contra indicators like brokerage reports. A lot of times when brokerage reports talk about uh, reduction in the targets or they become super bearish, it is considered, we consider it. I mean, I don't know whether other consider it or not, but we consider it is a bullish indicator, and it is also seen as typically near bottom. And right now, all the Numera, Golden Stack, Citi, Bernstein, they have given these previous targets were 29,000, 30,000. Now their targets are 24,000. So I am taking it as a bullish. Second contra indicator, as I already told you, this is SIP stoppage ratio, right? SIP stoppage ratio increased to 76% February. Okay. And I said that we may see SIP stoppage ratio exceeding 100% in March because this note is written on 29th of March and the data came on, I think, 12th of April, and which was exactly 101%, right? So it has increased uh, this this benchmark, which is 80%. And what we have seen, this is basically what we have tried to do is we have tried to plot the SIP stoppage ratio. And whenever the SIP stoppage ratio is minimum, the market has made the top. It means the crowd generally comes the most at the top. And whenever the SIP stoppage ratio is higher, let's say 80%, market has made the bottom. So as you can see in 2020, March 2020, right? And this one is, I think, July or something, 2019. This is again 2024, and now 2026 we are here, and again 2022, 2023. And as you can see, market has made top in 2000, September 2017 here, November 2021, and this should be, I think, July, August, September 2024. So markets have made top when the SIP stoppage ratio is minimum. And that's understandable also if you look at from common sense point of view. The crowd, as I told you, crowd is always right 80% of the times. 10% at the bottom, 10% at the top, they are not right where they should be. And that makes all the difference. That makes all the difference. People think that my money is getting managed by professionals in mutual funds and this and that. Professionals can only do their job if you are putting SIP every month, right? If you are choosing when your SIP should go, when you should do lump sum, when you should pull out the money, then this is not better than the DIY investing. You are doing DIY investing only. It's not professionally managed. One case had happened with me when one of my client came to me and he said ki my mutual fund uh, returns and so, and your returns are and so. Aren't you supposed to beat the mutual fund? So I asked him, how much do you SIP? He told me a number, 20K or 30K every month. And since when you are doing it? Last 10 years, right? When did you take our advisory? On September 2024. Are you doing SIP? No. So it's not better than the DIY investing, right? Either you do the lump sum as suggested by us, you do, or you do the SIP discipline, remaining in discipline, or it doesn't make sense, right? The seventh point is the peak bad news. It's more of a psychological point, as I've already mentioned. People are talking about nuclear wars. People are talking about they're hitting refineries. Crude production is already hit. So peak panic has already been priced in. Now, this is one thing that I didn't share because this has nothing to do with the bottom of the market, but this is more of a headwind tailwind indicator. This we have created by taking the actions of all the market participants that are promoters, DIIs and FIIs, whatever they are doing, right? If they are taking actions in favor of the market, then we take it as a tailwind. If they are doing the opposite, we take it as a headwind. And once it crosses one, that will be free flight to the moon. If it is below one, then there will be a free fall, right? And that's what we are seeing for uh, last 1.5 years chart is there. And this is nearly 0.85 or something, 0.88 or something. So I hope it goes above one in next 1 month or so. And then we will see a huge momentum rally. That will be the momentum rally, right? So, but the trend says that it is going in that direction. So I will keep updating on the social media about this. But right now we are at 0.88 or 0.89. So somebody might say, I will open the chat box, but somebody might say, hey, Nikhil, have you done these kind of uh, predictions in before also? And if you have, what was the result, right? You might be interested in knowing that. So we have done very, very small amount of such predictions of bottom and top because nobody is correct, right? And even if I am correct, bottom might happen 1 month after, 2 months after, and a lot of things. I mean, things can vary, and also my views can also change in 3 months, 5 months, 6 months. But we have done 2, 3 predictions only. So I will show you what we have done based on these indicators only, so that you understand that these indicators are credible or not. Based on these indicators, based on valuation and headwind tailwind indicator, we said on 16th of October 2024 that market is making top. And this is what we said, dear investor, we are going towards a big reset. We exited 6 number of companies. The only regret I have today is that we did not exit more number of companies. We exited nearly 25% of our portfolio. And this is after 2 days market made a top, which was huge. It gave a good boost to our overall CAGRs. But the only regret is if in future market becomes overvalued, I would like to be ruthless in exiting, like at least 40% of the portfolio, 45% of the portfolios. I would like to do that, right? We exited 2025 only percent. Same thing for on 22nd of July 2025. This is again a public tweet, and we posted exactly this. That valuation indicator is showing market overvalued again, and this was where the market was. And as you can see in the broader market also, if you go into July 2025, yeah, see, this is the section. This is the section I was talking about. And exactly from there, market actually made uh, a reversal, right? So this is exactly what I was talking about. From there, market made a reversal. And July 22, 2025, this tweet is off. And the second thing I shared was this same indicator, headwind, tailwind indicator, and which had seen uh, I would say 180-degree effect, but it again went down. It did not touch. So it was zero point 0.8, it did not touch 1, or it did not went above 1. So the tailwind was filled, right? And in the end, I shared when this thesis may not work, I was very clear whether oil goes up 10, 20%, 30% is not going to change my view, right? Escalation of war is not going to change my view. Uh, I mean, killing of 10,000, 20,000, 70,000, 50,000 people is not going to change my view unless there is a nuclear war or assassination of US president. Such things, my view is not going to change unless there is a war where millions of people die, right? So in that case, this thesis may not work. And as I've told you already, headwind tailwind indicator is something that we keep looking after every month. And if this changes, my view may change. But unless everything is thing this here. And one thing I noticed in our portfolio, that the recovery that we saw in last 14 days, maybe it's because of the lower base effect or something like that, but we saw a very revenge recovery in last 14-15 days. Of course, it doesn't mean anything in the long-term wealth journey. So, but I was just looking at it. Whatever we lost from January to March, so nearly 2.5 months of correction we made in last 10 days. So that was something very huge, right? Of course, that also includes we are buying at bottom also. 28th, we did some buying, 8-10% of our portfolio. So this is all from my side. Yes, this is action point. Action point is very simple. This is what we have given to our clients, that we have already suggested to invest heavily in the suggested stocks. Let's say your stocks allocation is 10, 20, 30%. I would definitely suggest you to take it 40, 50, 70%. If it is 70%, take it to 80%, 90%, right? I am personally invested 95% in the market. I was invested 95% this day, and now I'm invested 99, I think, 98, 99, right? So I will not suggest you to liquidate your physical gold and silver or something like, or real estate, and put that money into the market. But definitely you can liquidate your bad performing assets if you have some bad performing mutual funds, or if you had bought gold or silver, fortunately, definitely liquidate 10-20% and put into some good quality stocks. It would be a wise choice because it's just 14 days. I mean, I think whatever the revenge recovery I'm talking about, maybe the stocks will again go down. Maybe we will see huge correction again and market will again form a bottom. But the essence is that midterm bottom we can see midterm bottom made, right? And one more action point I would like to say here is, before I take all the questions, is try to talk to your advisor, right? Uh, if I'm talking to my client, then that's great. If you are from outer circle, you listen to me, and that always go with an advisor, because market is an ever changing place and lot of things happen here. Things change in 3 months, 6 months. If you are investing in mutual funds, have a mutual fund advisor. Don't go for that 0.5% bullshit, right? If you have equity, you have an equity advisor. Don't try to save that. Don't see, being cheap has never helped anybody. Okay, being cheap has never helped anybody. Go with the mutual fund advisor if you are into mutual funds. Go into, if you are in equity, go with the equity advisor. uh, Go with us, go with somebody else, but try to take view from the professionals. I have seen a lot of professionals who are very, very good at their job, very good doctors, engineers, lawyers, and all those people, and when it comes to the market, they suck so well. And I've seen a lot of people who can talk about almost anything. They can talk about AI, they can talk about job cuts, they can talk about IT, chemical, they can talk about China, Europe, they can talk about Russia, Ukraine, India, America, India, Pakistan, trade war, tariffs. And when you ask them their CAGR, they will tell you 10%, right? All this knowledge gathering, all this hard work, and after 10, 15 years, you will see your CAGR to be 11 or 12%, right? So it's really not worth it. Have have somebody professional who can look into that, who can give you a proper guidance. That is my action point. I mean, some people might say, I have a conflict of interest, but I cannot give more stress on this subject. Okay. If you have any questions, I will not be talking about companies. First of all, if you have any question related to the parameters that I have shared, please, please share. Okay. Thanks a lot, everyone. Thank you.